close your eyes for a moment and picture this. A sun-drenched luxury villa in Phuket.
Yeah.
And remember, that's Phuket, not Phuket. Infinity pools, ocean views. Just imagine owning a piece of that.
It's the dream for many, absolutely.
It really is. But, like any amazing view, there's a practical side just beneath the surface, especially when it comes to things like, property taxes for foreign investors.
That's where it gets complex, yeah.
Okay, so let's unpack this. Our mission today for this deep dive is really to cut through all that confusion. We want to give you a clear kind of strategic guide to smart tax planning in Phuket so you can, focus on enjoying that incredible investment, not sweating the regulations.
Makes sense. Get the planning right up front.
Exactly. And today we're digging into a really insightful article. It's called Phuket Villa Tax Guide for Foreign Owners.
Yes, that way.
It comes straight from the Ocean Worldwide blog, and their perspective here is, particularly valuable.
It really is. And what makes Ocean Worldwide such a trusted voice in this whole area is their deep roots there.
Right.
They're a luxury residential real estate agency, actually founded right there in Phuket way back in 2004. They also cover Koh Samui.
Since 2004, wow.
Yeah, and their director, Sandra O'Neill, she has personally helped literally thousands of families and investors over the years. So this isn't just theory,
No, it sounds like real, practical, on-the-ground experience.
Precisely.
Yeah.
Which is exactly what you need in a market like Thailand's. It's dynamic.
Absolutely. So think of this deep dive as your essential GPS navigating the financial side of Phuket property. We'll map out everything.
Yeah.
The initial fees to get the keys, the annual taxes, renting it out, even those trickier ownership structures.
And I think for many foreign investors listening, this really hits on a key question, doesn't it?
Which is?
How do you balance that undeniable allure, the dream of the Phuket villa, with the absolute need for, let's say, watertight financial planning and long-term security too?
Yeah, it's about protecting the investment, not just making it.
Exactly. Understanding the mechanisms behind it all.
So that initial dream is powerful, definitely. But let's anchor it in reality. Before you even get those keys, feel that sea breeze. There are some essential government fees, taxes involved just in transferring the ownership. Let's call them the upfront costs of getting into paradise.
You're right. And it's really crucial to get the difference between the sale price you agree on and the total cost.
Ah, good point.
So first there's the transfer fee. That's 2% of the property's appraised value, the government's value, mind you.
Okay, 2% of the appraised value paid to the land department.
Correct. And interestingly, this fee is often something you negotiate. Sometimes the buyer pays, sometimes the seller, sometimes it's split 50-50.
Okay, so that's negotiable. Good to know. What else?
Then you got stamp duty. That's typically 0.5% of the sale price.
0.5%.
Yeah. But this usually only applies if the seller isn't liable for something called specific business tax. We'll get to that. Basically, if the seller has owned the place for over 5 years, they probably avoid the specific business tax, and then stamp duty is what applies instead.
Got it. So what's this specific business tax then? It sounds important.
Oh, it is. It's the specific business tax, or SBT, and this one's a biggie, 3.3% of the sale price.
Whoa, 3.3%. That's quite a jump from 0.5%.
It really is. It's kind of designed for what the authorities see as property traders, people flipping properties quickly rather than long-term holders.
Oh, okay.
So if a property is sold within 5 years of being bought, that SBT will almost certainly kick in.
5 years is the key time frame then.
Exactly. But the good news is there are exemptions. Hold it longer than 5 years, or if you inherited the property, you generally avoid this big 3.3% hit.
Okay, so that 3.3% SBT, it's like a silent countdown, isn't it, on a, say, 50 million baht villa?
Yeah, do the math.
That's 1.65 million baht just saved by holding on past that 5-year mark.
It's a huge incentive for patience, definitely. Ignoring it means leaving serious cash on the table.
So, understanding these initial costs. The transfer fee, stamp duty, or SBT is fundamental for accurate budgeting. Don't let them catch you out.
Absolutely crucial first step.
Right. So once you've cleared those initial financial hurdles and you're the proud owner enjoying that villa, the tax journey isn't over, is it? Just like council tax or property rates back home, there are annual duties, ongoing costs.
Exactly. And there are 2 main annual taxes to be aware of in Phuket. The primary one is the annual land and building tax.
Okay, land and building tax.
Yeah. And the rates aren't fixed. They actually vary quite a bit depending on how you use the property.
How so?
Well, if it's your primary residence, you get much lower rates, usually around 0.02% to 0.1% of the property's assessed value.
Oh, that sounds quite low.
It is, comparatively.
Yep.
But if you use it commercially, like for rentals, or if it's just vacant land, the rates jump up. Think 0.3% to 1.2% for commercial use, or 0.3% to 0.7% for vacant land.
Big difference there.
Huge. And there's another really crucial benefit here, especially if you're thinking about actually living there long term.
Go on.
The first 50 million Thai baht of a primary residence's value is completely tax-free.
50 million baht, exempt.
Totally exempt, but you need to qualify, of course. Generally means officially registering it as your primary residence with the local authorities, showing it's your main home, not just a holiday spot.
Wow. Okay, that 50 million baht exemption, that's a serious perk for genuine residents. What's the second annual tax?
The second one, if it applies to you, is the local maintenance tax on rental income.
Okay, only if you rent it out.
Right. If your villa is generating rental income, this tax is levied on that annual income. It's usually somewhere between 0.25% and 0.95%.
And where does that money go?
Often directly towards local things, infrastructure, services. So it's separate from your main income tax liability. And again, you need good records to calculate it correctly.
That 50 million baht exemption really changes the calculation for annual costs, doesn't it? If you're planning to retire there, maybe.
It absolutely does. For someone making Phuket their home, that could free up significant money each year.
Yeah, for travel, enjoying the local scene.
And if you step back and look at the bigger picture, these annual taxes, especially with that primary residence benefit,
Yeah.
they really seem designed to encourage that long-term investment, building a stable community rather than just, short-term speculation.
Fostering commitment makes sense.
Exactly.
Okay, so moving on. Many foreign owners in Phuket, quite wisely, look at their villas as an income source, too. It's a smart way to make the investment work harder.
Very common strategy, yes.
But obviously, that brings in another layer of taxes, specifically on that rental income. Let's make sure everyone knows the obligations there.
You've hit on a really key area. If you're a foreigner and you're renting out your Phuket villa, the tax on that income is actually quite straightforward in principle.
Okay.
You'll generally be taxed at a flat rate, 15% on your gross rental income.
15% flat rate on the gross.
Yes, gross, meaning before you deduct any expenses. And that flat 15% applies whether you're technically resident in Thailand or not.
Right. But you mentioned deductions. Surely there are expenses you can claim.
Yes. While it's a flat rate on the gross, there are absolutely crucial allowable deductions. This is where keeping meticulous records really, really pays off.
Okay, like what? What can you typically deduct?
Well, common things include repairs and maintenance. Keeping the villa looking great costs money. Receipts for fixes, upkeep are usually deductible.
Makes sense.
Property management fees. If you hire a company to handle bookings, cleaning, etc., their fees are deductible.
Good.
Utilities and service charges that you might cover as part of the rent. And even depreciation.
Depreciation. This always sounds complicated.
It can be, yes. The Thai rules around depreciation, especially for foreign owners or company structures, can have some nuances, like different parts of the property might depreciate over different timescales. It directly affects your annual tax bill. Honestly, this is one area where getting advice from a local accountant is almost always worth it. Highly recommended.
Right. Get professional help for depreciation calculations. Got it. Anything else on rental income tax?
Yes, one more really vital concept.
Yeah.
Withholding tax.
Withholding tax.
Yeah. When you receive rent, especially from a company or maybe a rental agency, they might be legally required to withhold a portion of that rent, usually 15% for rental income, and pay it directly to the taxman on your behalf.
Like an advance payment.
Exactly. It's an advance payment towards your total income tax bill. Now, the absolutely crucial thing here is you must get the official withholding tax certificates from whoever paid you.
Why are those certificates so important?
Because when you file your annual tax return, you use those certificates to prove tax has already been paid. It offsets your final tax bill, so you don't end up paying tax twice on the same income.
Okay. Proof of payment. Essential.
Essential. Don't lose those certificates.
So, boiling it down, what does this all mean for your actual profit? Knowing what you can legitimately deduct and managing that withholding tax, it can make a huge difference to your bottom line.
A dramatic difference. That's not just about the rent you collect. It's about managing the net income effectively.
Yeah.
Smart management pays off.
Definitely. Okay, now let's tackle one of the maybe more complex areas, but also potentially really rewarding for foreign owners.
Mm-hmm.
And that's how you legally structure your ownership, especially because of Thailand's restrictions on foreign land ownership. This isn't just about tax, it's fundamental legality and security.
This is absolutely critical. The general rule, as many know, is that foreigners cannot own land outright in Thailand.
Right. Common in many countries.
It is.
Yeah.
But there are established ways to navigate this. For condominiums, it's a bit different. You can own condos freehold, outright ownership,
Okay.
but there's a catch. Foreigners, collectively, can't own more than 49% of the total sellable area in any single condo building, the foreign quota.
Ah, the 49% rule. Heard of that. What about villas or houses then, where you usually want the land too?
Yeah, for villas or houses, direct land ownership by a foreign individual is generally not allowed. Now, you sometimes hear about Board of Investment promotions potentially allowing it,
Right.
but honestly, those are typically for massive strategic investments like huge resorts or industrial projects, not usually for an individual buying a single villa. It's not really a practical path for most buyers.
Okay, so for the average villa buyer.
For most, it comes down to two main routes: leasehold agreements or setting up a Thai company to own the property.
Leasehold versus company ownership. Let's break those down. Leasehold first.
Okay, leasehold basically grants you the right to use the land for a fixed period. The standard initial term is 30 years.
30 years.
Yes, usually with options to renew, often for further 30-year periods. So you effectively own the building on the land, but you're leasing the land itself. Freehold, again, is that outright ownership, but typically just for condos within that 49% quota.
Got it. So the other option is using a Thai company.
Correct. Leveraging Thai company structures. Now, there are definitely pros here. A company can be an effective way to manage rental income tax, and it's a very common method used to structure the ownership of land for foreigners.
Okay, sounds potentially good. What are the downsides?
Well, there are significant ones and crucial compliance points. You'll definitely have annual costs, things like preparing audited accounts, filing company tax returns. You need to budget for these ongoing expenses.
Right, admin costs.
And the Thai authorities look very closely at these companies. If a company looks like it exists only to hold property for a foreigner with no real business activity,
Uh-oh.
it runs the risk of being dissolved. And potentially, the property could be seized. It's absolutely not a set it and forget it solution. It requires active, genuine management.
So it needs to be a real functioning company, not just a shell.
Precisely. And then there are tax differences, too. Transferring property, for instance. A company might face that 3.3% SBT we talked about, whereas an individual holding long-term might just pay the 0.5% stamp duty. But then again, when selling, a company often benefits from a simpler 1% flat withholding tax, which can be easier than the individual calculations. Swings and roundabouts.
Okay. And what about setting up the company itself, the shareholder?
Ah, yes. Shareholder structures and compliance. This is critical. A Thai company legally needs a majority of genuine Thai shareholders.
Majority Thai shareholders, okay.
And genuine is the key word. They must have a real financial stake, real involvement, using nominee shareholders, basically, Thai people who are just names on paper with no real investment or control.
Yeah.
That is completely illegal. And the penalties are severe.
Yeah.
Heavy fines, potentially imprisonment for those involved, and even the forced sale of the property.
Wow. So absolutely no cutting corners there.
Absolutely none. This is a major red flag area. Do not compromise on the legitimacy of the company structure. Get proper legal advice.
Right. So this point about the company structure, it can offer advantages, sure, but it's definitely not a simple workaround. It has to be legit, actively managed, maintained.
Exactly. It's often more suitable for larger investments, maybe multiple properties, or if you genuinely intend to run a business alongside owning the property, giving it that clear commercial purpose, not usually for just one holiday home.
Okay, that clarifies things. So beyond just understanding all these rules, are there smart, proactive ways to, optimize your Phuket investment, protect it better?
Absolutely. When we talk about optimizing tax planning, a few key strategies really emerge from the source material.
Like what?
Well, one of the simplest, we've touched on it, is holding the property for more than 5 years. Just doing that avoids the hefty 3.3% specific business tax when you eventually sell. Think of it as a loyalty bonus from the tax man.
Good way to put it. What else?
We also talked about the primary residence benefits. Don't underestimate those. Lower annual tax rates plus that huge 50 million baht exemption if you register it as your main home. That's significant annual savings.
Definitely worth exploring if you plan to live there.
Also, Understanding the accurate appraisal values used for the annual taxes can be useful. These aren't arbitrary numbers. They're official values. And, I know we keep saying it, but meticulous records for deductions on rental income and depreciation.
Keep those receipts.
Always. Beyond those basics, you might also look into how property ownership could potentially link to long-term visa options, or perhaps explore tax treaties between Thailand and your home country. Sometimes those treaties can help reduce your overall global tax burden.
Right, looking at the bigger picture, how it fits with your overall financial life.
Exactly. It's about integration, not just isolation.
All of this complexity, though,
Yeah.
it really leads somewhere important, doesn't it?
It absolutely does. It leads directly to the critical importance of getting proper legal counsel.
You might think, why bother? Can't I just sign the papers, save some money up front?
And that, honestly, could be a catastrophic mistake. Here's the stark reality. In a foreign legal system, especially concerning property, without expert local legal advice, your dream villa could, metaphorically speaking, be built on quicksand. A good lawyer isn't just a cost. They are your essential shield.
A shield against what, specifically?
Against things like title deed fraud, which happens. Against unscrupulous developers. Against getting involved in those illegal nominee structures we warned about, which can cost you literally everything.
Okay. So what does a good lawyer actually do for you?
They provide invaluable protection. They conduct thorough title deed verification, making sure the title is legitimate, ideally a Shinote title, which is the most secure type in Thailand, guaranteeing ownership and clear boundaries, checking for hidden debts or liens on the property.
Crucial checks.
They meticulously review contracts, especially the sale and purchase agreement, spotting potentially unfair or risky clauses you might miss. They do due diligence on the developer or seller, checking their reputation. Financial stability.
Peace of mind there.
They give you expert ownership structure advice, guiding you through leasehold versus company setup, ensuring compliance, and fundamentally, they ensure secure transactions. Every step, from deposit to final transfer, is done legally and safely, protecting your funds.
So it's really about risk management.
Absolutely. And part of that due diligence includes checking things like zoning rules and building permits. Is the villa even legally allowed to be there?
Good point.
And for condos, if you're bringing money in from overseas, they'll make sure you have the necessary foreign exchange transaction form, or FETF, from a Thai bank. You need that form at the land office to prove the funds came from abroad legally.
Right, lots of details to get right.
Any details.
So what this all really boils down to for you, the listener, is that spending that bit extra upfront on quality legal advice isn't an expense, it's an investment.
It truly is.
Yeah.
It can save you an absolute fortune, not to mention immense stress and heartache down the line. It's about security and peace of mind.
Couldn't agree more. Okay, so we've covered a lot of ground today. Journeyed through the often complex world of Phuket property taxes. From those initial transfer fees and the annual ownership costs to handling rental income tax and making those big strategic choices about how you structure the ownership.
It's quite a landscape.
It is. So let's recap the key takeaways from this deep dive. Remember, understand all those upfront transfer fees. Leverage that 5-year rule to hopefully avoid the big specific business tax. Know about and use, if possible, those primary residence benefits for annual taxes. Meticulously record all your rental expenses for deductions. And maybe most importantly,
They give legal advice.
always seek professional legal counsel.
And stepping back, just thinking about the bigger picture here. A secure, profitable property investment in Phuket isn't just about finding that perfect villa with the amazing view. It's really about making informed strategic decisions at every single stage, especially in such a dynamic market. Staying compliant with the tax laws, which can change, and using expert guidance. That's really paramount if you want to protect and maximize your investment over long term.
Well said. Okay, so beyond all the legal frameworks, the financial planning we've discussed today, here's a final thought to leave you with.
Okay.
Consider this. What are the broader evolving trends we're seeing in global luxury real estate right now? And how might a truly optimized, securely structured, and well-managed investment in a place like Phuket position you, not just financially, but maybe as a more strategic player within that exciting, constantly changing global landscape? Something to ponder.